So that's when we come over here and we look at what are the methods. Let's move the camera a little bit just to make sure that you can see it. What are the methods available in today's market to replace what you're currently spending for electricity with something smarter? Let's look at it like an investment. Here's the main question right here. This is really important. Do you pay federal income tax? If the answer is yes, you're most likely going to want to look at one of these two finance options. If the answer is no, you don't pay federal income tax, you're going to be looking at one of these two finance options. Now, I like to inform every customer, and I train all of our salespeople to inform customers that every method of finance has pros and has cons. Good upsides and downsides. It really just depends on what your current situation is, which is why I preface this conversation with which one of these do you not want to pay for? Because the reality is you don't want to pay for transmission, but you do. You don't want to pay for generation, but you do. You don't want to pay for operation and maintenance, but you do. So as we come over to these, sometimes people get hung up because of an interest rate. Right here we got 2.99 through 7.99. Different finance options will present a different interest rate, oftentimes dependent on the term or your credit score. Now, a very common situation is we can propose any one of these and show a tremendous savings against current utility costs, but people will get hung up because they don't want to pay a 5.99 rate over a 2.99 rate, even though they're saving 50% versus their current electric bill. Does that make sense? You're afraid to pay an interest rate, but you're paying all these things that you don't want to pay for. So what I'm trying to do is marry the concept together and help you realize that at the end of the day, all you want are kilowatt hours. We're just trying to find the most intelligent way that fits your situation. So let's talk about if you pay federal income tax. The reason why one of these two works is because you'll take advantage of the tax credit and therefore bring the actual net investment out of pocket for you down. If you don't pay federal income tax, for example, somebody who's retired on a fixed income and has a tight budget, yet they still want to save some money on their electric bill, they're going to go for a lease or a power purchase agreement. The difference between these two simply in this video is a lease is a fixed monthly payment. A power purchase agreement is a lease, but the payment is variable depending on what the system produces on a monthly basis. Now, I realize I'm covering a lot of information. The point of this is it gives you the ability to rewatch this video or these videos, and hopefully all this stuff sinks in and makes sense. Now let's talk about some of the pros and cons that are related to each one of these. For example, cash. Pro is you don't have any loan payment to pay. Your electric bill goes down to virtually nothing, and you don't have to pay the utility anymore. Other than the membership fee, what's also referred to as the interconnection fee. But then we go with a loan. A loan is going to be on your credit score, and some people see that as a bad thing. And then they have a variable interest rate. That's the downside of a loan. The upside is if you sell the property or refinance, it has no impact on the buyer. Where all three of these actually do have an impact on the buyer. So for that reason right there, for tax-paying people, this, in my opinion, is the #1 way to buy solar. Either cash or loan. #1. But that depends on your situation. As we come over, and usually these, if they are an unsecured loan, then they don't have a lien. If it's a secured loan, for example, if you get a home equity line of credit, this HELOC, I'll write this here, HELOC, for example, that would look like a cash deal to the contractor. That is an unsecured loan to the system, but it's secured against the property, which gives you interest deduction on that loan. So there, at today's current rates, that might be I'm going to use my black pen. If you got a HELOC, that might be like a 5.99 rate, but you get the interest deduction on that. So the payment might be a little bit higher, but you get the interest deduction. If we move across to PACE financing, generally people who use PACE are going to be doing something more than just one project. For example, solar. If you're just doing solar, this might work really well. If you're going to be doing solar and roofing and air conditioning and something else, PACE, property assessed financing, would go there. Now, that one, both of these, by the way, add property value. So anything above this tax line adds property value to the house. How much value? That really comes down to, if you can see this down here, the knowledge of the appraiser, which is, I'm just going to go into this right now. I'll leave a little pause because we may want to create a separate video on this one. The knowledge of the appraiser ultimately becomes the true determiner of the value, because they're the ones that are going out and appraising the property. Quick story here. Had a conversation over past Thanksgiving. I'm sitting around with my family and my brother-in-law, my other brother-in-law. We were talking general solar conversation. One of them is an appraiser, and he starts asking me questions, so I asked him questions in return. And really in that conversation determined that he didn't necessarily know how to, which, other than this question, that is the reason for this video, because I realized in talking to a veteran appraiser, he was going to the real estate agent. Realtors don't know this. They just know that there's a lot of leases and PPAs out there that cause challenges in refinancing and selling of the property. If you're the buyer of a property and there's an existing lease in place, yes, it's transferable, but maybe that buyer doesn't want it. Or maybe the lender doesn't want that. So that can cause what I call a secondary decision. This, one decision. You buy it, it's done. If you sell the property and there's still a loan balance to be paid on that loan, you take the proceeds out of the property and pay that loan off. Now, if you have an educated appraiser and an educated real estate agent, you should at least recoup your initial investment minus the tax credit. Here we are with this line again. So this one right here is the easiest to qualify for, the easiest to buy, the easiest to sell, and adds the most value to your property. And it's the simplest for the appraiser and real estate agent to quantify the value and help sell the property. Number one, right there. Number two, above the tax line, is this PACE. Now, PACE, property assessed, does have a lien on the property, but it's not on your tax credit, or I'm sorry, on your credit score. The property itself is basically taking the loan out, not the occupant of the loan. And the reason for that is it's for energy efficient products, and the hope is that the new buyer just assumes the loan and it stays with the property. It's very similar to an individual mellow roofs. For example, you might buy a house that is in mellow roofs territory, and that's a 25-year loan that the whole neighborhood has, that the developer took on. This would be an individual house mellow roofs, where once that loan is paid off, it's gone, but it could be 3 or 4 buyers later that ultimately pay that loan off. It also has interest tax deductibility because it is secured on the property. So if we go really quick, the interest rate on that is generally higher than on these loans. It is secured, which gives you the interest deduction. It is transferable. However, in the recent years, there have been some lenders that didn't like the fact that it's on the property tax bill, and therefore it's in first position ahead of the mortgage company. I think that kink has kind of been worked out, but that can sometimes cause some challenges. And hopefully you can appreciate that I'm exposing all the pros and cons to all these finance methods to help you ultimately determine which one works right for you. But don't be afraid of those things, because ultimately they're giving you control. Right now with your utility and no solar, you have zero option, zero ROI, and zero control. So there's got to be a little bit of a give and take, a risk versus a reward. Over here, you don't have much risk other than the fact that you got to pay that bill, and there's also no reward. Over here, you're going to be assuming some risk. You're taking debt on, but you're going to be able to pay that debt off at some point in time, therefore taking control over your energy costs into the future. Here, the risk is based on a lien on the property, paid back on your property tax bill, and maybe a mortgage company in the process of selling the property doesn't want to see that. Now let's go below the line. Let's say you don't have taxable income. A lease or a power purchase agreement is going to most likely be what you would select, because the finance company that owns that asset is going to take the tax credit and the depreciation and share some of those benefits through to the host customer, the person who's actually got the solar system on their house. They're going to share some of those benefits in the form of payment. Now, these are generally 20-year terms, and pros and cons between the two. If you were to take the payment on these, they often have an escalator, which means they're going to go up just below utility rate inflation rates. So you're going to save money, but you're never going to ultimately take control of your energy costs. They also do not add any equity to the property. And that can cause, depending on the appraiser, if you have a leased or power purchase agreement solar system on your roof and you try to sell the property, depending on the appraiser, it might not come across right in the appraisal, and the new homeowner might say, pay that solar system off, I don't want to pick up the remainder of the term on that lease. I have seen in lease situations where the leasee, I always get these confused, leasee, ends up having to pay the lease off, the cash out value, just to get that buyer to take over the home. Same thing with a power purchase agreement. It's really just another utility. These two down below the line are just another utility. And I would like to reference some of our other videos that talk about what may happen with lease and power purchase agreement asset holders. They, in essence, are just banks like a mortgage. They're holding these assets. They bundle them, they sell them off to somebody else so they can procure more money to go out and provide more leases. Those bundles may end up getting purchased back by the utility who has lien rights. So, doesn't mean that they're a bad deal, just want to expose potential options here. Power purchase agreements are different from a lease in the way that with solar, the production is going to fluctuate depending on month and depending on season and year. This is a fixed payment every month. This is based on actual power production. So in the process, it might be 0.15 cents per kilowatt hour, which is a savings over what you may currently be spending. But at the end of the term, you really want to measure full payment value and what you're actually spending against what your full payment value would be against a purchase, especially if you have taxable income. We want to be clear here that above the line adds equity to your property and you gain control and value. On the pro side, the downside, it's on the credit ratio or a lien on your property. Down here, it does not add equity to the property. It's like an off-balance sheet loan. Yes, you are on the hook for the full term payments, and that is controlled through something called a UCC1 filing. UCC1 filing is like a pink slip. So the finance company, the asset holder that actually owns that equipment on the roof of that lease or PPA customer, has the ability to claim rights to it. Some other things that are not generally discussed when it comes to leases and power purchase agreements is there's an easement applied for by that asset holder so that they have access onto the property to maintain that equipment or have access to it. So that leads me to another thing, maintenance. This is a very common topic when it comes to selling a lease or a PPA, which I'm going to talk more about in the third video, or in the next video in this series that relates to this. And it talks back to the warranty. There are typically on a purchase, you have a 10-year labor warranty with a 25-year energy production warranty and equipment warranty on panels and inverters with 10 years on the labor. Down here, they say everything's covered for 25 years from a warranty perspective, but you have to keep in mind that they're actually going to go back to the contractor that installed that system. They're not the installing contractor, they're just the finance company. And they'll go back to that original contractor, which means that there's subcontractors installing that. On a purchase like this, you're generally getting directly to the contractor. Pros and cons there. In a highly competitive industry, you want to allow that contractor to make some money. It's not a bad profit's not a bad word. You want those companies to be in a profitable position. That ultimately is your best way of maintaining a long-term warranty situation. Now, is there maintenance? There really isn't. A question I like to ask is, how much do you worry about maintaining the electrical infrastructure in your house? Lights, switches, plugs, wires, breakers. Chances are you probably don't even think about it at all unless a light bulb goes out. Not a very big expense. Solar is very similar. There's no moving parts, and if something is going to go bad with a panel or an inverter, it generally goes bad right away. Out of over 6,000 solar installs at this point in time, we've had a ridiculously low number of warranty claims, and when they happen, they generally happen really early on. So maintenance is often used as a sales tactic. And another thing I'd like to point out here is we're doing these videos so that you have the ability to ponder which one's right for you. Generally, if you got a lease or a PPA, you were not informed on all of these things. You were generally sold a cost per kilowatt hour only. And against my concept over here, which is what do you really want? Kilowatt hours. But I believe there's more to it than kilowatt hours. You also want options and control, along with equity in your property. There's more to this than just the cost per kilowatt hour. There's options, control, and equity. It's an investment. So UCC1 filings, back to that point, they do have the ability to file a lien if you don't pay for that lease payment or that power purchase agreement payment. So that really turns out to be just another utility. Ultimately, these ones you can pay off, get rid of your electric bill. These ones, you're going to have to make another decision down the road, whether that's at lease end, renewing, buying it out, or when you sell the property, you become the salesperson getting the new home buyer to assume the same transaction that you found to be attractive for your situation. Maybe they want this. So these are all really important things to consider. Now, on the next video, we want to cover what's in the cost. And that's two different perspectives, because true value ultimately is based on the knowledge of the appraiser, the realtor, and the buyer. And if they're not educated properly, you may not see the real value of it. But at the end of the day, it's still got to get built. This is a contracting industry. This is not a finance industry. However, finance is the vehicle that we use to get it built. So I'm going to wipe all this stuff off. I'm going to write the next stuff down. I really appreciate you taking the time. I hope this information gave you some good value, some good content, something to think about, and look forward to seeing you on the next video. Thank you.